Welcome to Excess Returns, where we focus on the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack interviews Yuri Khodjamirian, CIO at Tema ETFs. Yuri explains how Tema's approach to identifying moats is different from the traditional methods, as they look for companies with dominant market share, tangible assets, and long-term durability of returns. Throughout the discussion, they delve into the various types of moats, such as economies of scale, strong network effects, non-replicable physical assets, regulation, and high switching costs, while also discussing how these advantages apply to different industries and how to evaluate potential risks to a company's moat. Yuri also shares insights on the firm's investment process, which blends quantitative and qualitative analysis, and how they construct portfolios of these high-quality companies. As always, thank you for listening.
Yuri, thank you for joining us.
Hi, Jack. Nice to meet you. Hello.
Nice to meet you as well. I'm really excited for this topic because this is a topic a lot of investors spend a lot of time thinking about. And it can also be a very challenging thing to do. And what we're going to talk about today is the idea of moats and durable competitive advantages. And what I like about what you guys are doing at Tema is you found a unique way to do this. There's been some traditional ways people look for these moat type companies, and you found a very different way to look at it. And I think it's really interesting. So I'm excited to dig into it today.
Yeah, I'm also excited. Look forward to jumping in.
So before we start, I want to get back to what I just said, which is this idea that a lot of people are spending a lot of time trying to find these companies that have moats. And I want to get into why. What are the advantages of investing in these types of businesses that have moats or durable competitive advantages?
Yeah, so look, I think what a lot of people are looking for ultimately is quality companies, right? And quality companies often have high returns on invested capital. And the beauty of high returns on invested capital, as one great investor once told me, is it sort of does your work for you. So a company that has high returns, if it can just compound that over long periods of time, well, then, as an investor, you just reap the rewards in terms of the rising equity value of that business. So it's a sort of a holy grail of investing, if you will. And moats are effectively a way to defend that high return. And so essentially what you get is a set of companies that have high returns on invested capital, but also have like durability and high visibility of those earnings. And it makes them these kind of beautiful sleep at night type stocks, which everyone is out there hunting for. And so often what people, when they're trying to say a moat, they're saying defendable, high returns, high profitability. The other thing is, as we all know, it's like having extra money in your pocket. So if you have high profitability, high margins and things like that, it's just easier for you to invest in the future, to fend off competition. It gives you more breathing room as a business.
And how do you think, before we get into how you think about this a little bit differently, what do you think the traditional definition of a moat is? How a traditional, funds or investment managers who try to find companies with moats, how do they do that? And how does what you're doing differ from that?
Yeah, so I think the definition originally, I think you probably ascribed to Warren Buffett. You talked about this idea of moats as a kind of, it's a really nice concept, right? It's this idea that there's this bit of defense that sits around the castle of the company. And, but I think the traditional definition is really just barriers to entry of any competition into a particular industry or company. And what happens is you have high returns. And if you can kind of fight off that competition, you can keep those returns higher than the average cost of capital for a long period of time and almost beat the fade, if you will, because competition is the force that gets returns to come back down to their cost of capital. So if you can find a way to keep it at bay, that's what a moat does. So that's the kind of broad traditional definition. And in terms of kind of where we're different, I think it's getting more and more understanding of what a moat is and its nature. What is really interesting when you start studying this and spending time looking at these types of companies is not all moats are the same. And that's the bit that probably gets skipped often because people think it's such an attractive concept. I'm just going to jump in and whatever moat there exists, that's what I'm going to invest in. But the truth is there's lots of elements that need to be considered that make moats better than the traditional definition.
And I would think, and we're going to get into this in a second, but I would think in the world of technology, now that technology plays such a huge role in our economy, that sort of changes these types of protections businesses have versus what they did, back in the day.
Yeah, exactly. And so what we're always looking for types of specific bits of moat that if you kind of work them all together, you create a much better subset of moat companies. So we're looking for dominance. So companies that have high market shares. A lot of traditional moat definitions, they don't really look at market share. They consider it as a little bit of a sideshow, if you will. If you look at some of the analyses that Pat Dorsey's done, they say, having high market share is not enough. And it certainly isn't enough, but it's a very important feature. And often you have to start with that, which is one of the things that we look at in our fund. The second bit is this point you're talking about technology. And what we're focused on is tangibility of that moat. The way the economy and the stock market has moved on is that there's this idea that moats, intangible value and brands and technology are the real powers of the economy right now. And what we're saying is we're sort of trying to go back to the old definition of moats. We're looking for real, hard, tangible things that you can kind of hang your hat on as an investor. And finally, where we sort of are different is about the durability. We start by looking at durability. And what a lot of investors tend to start with when they think about moats is they think how wide a moat is. And really how wide is the ROIC versus WACC. And they think that the wider it is, the longer it will take for it to fade. But the truth is what you need to do is you need to start by thinking about the durability of that particular moat. It doesn't really matter how wide it is because compounding is this powerful effect. If I can find just a slim advantage that lasts for a very long time, you're actually better off doing that than looking for something that's really wide that might fade over time. And so if you combine those three things together, you start to think, okay, that's a different definition of moats. It's more real, it's more tangible. It's more about dominance and tangibility and durability of those moats. And we can obviously talk about technology as an area where this can be applied.
So you have a great presentation here you're going to give. And one of the first things we're going to look at is this idea of the different types of barriers to entry, because I think this really gets at this idea of defining moats a little bit differently when we think about the different barriers to entry that you look at. So I want to go through each one and maybe talk about what it is and also maybe some examples of the types of companies so people can understand what it is. And the first one is economies of scale. So how do you think about that?
Yeah, absolutely. I mean, the premise here is that all moat investing starts with understanding what are the different types of barriers to entry that exist in different industries and different companies. And they're classically a bunch that get defined. And we've tried to narrow it down to this set that we think is going to be the most powerful in terms of those elements that I talked about: tangibility, dominance, and durability of those moats. So economies of scale. I mean, look, this is the idea that you can manufacture at scale in terms of really, really high amounts of output. Effectively, the average cost of that production goes down so much that you're much better than any competitor. So therefore, your manufacturing position is very strong. And I think that is really telling with an example of the semiconductor industry. What happens in the semiconductor industry is that if you go to a single fab in Taiwan, what's amazing is that they manufacture more than any other factory in the whole world. In fact, if you take all the factories combined, the number of transistors manufactured in one fab is more than all of the things ever produced in the history of mankind. And that gives you scale, right? Even though it's down at the microscopic level, we're manufacturing so much of it, the individual cost per transistor or per semiconductor goes down. And so that's this idea that manufacturing those particular fabs gives you that advantage versus a competition. Paint is another really great example where the bigger the plants are, the more paint they can produce, the cheaper they are relative to their competitors. And they can use that extra profit to reinvest in growing or other things. And I think that's another really important element that I talked about before, that breathing room, that if you have profitability, you have these barriers to entry, it creates this breathing room which management can allocate to protect the business in various ways.
Yeah, I was thinking about that idea of semiconductors. I mean, if you think about what it would take for companies to compete with the big firms in that area, I mean, it is incredibly massive. Even like governments are trying to probably invest in massive amounts of money to compete with them, and they're out of a difficulty. It's just very, very challenging.
Yeah, absolutely. I mean, it's probably the pinnacle of what we've achieved in terms of manufacturing as humans. There's a beautiful article written in Wired about this, and it's really understanding like what has been achieved in terms of manufacturing. And even though we're manufacturing at the microscopic level, I mean, some of these transistors are down to the 2 nanometers size. The idea is that you can manufacture so much of it because you're manufacturing at such a small scale that you have a massive cost advantage versus anybody else. And there are fewer and fewer and fewer people that are able to do that as every year goes by. I mean, even Intel's is dropped out of that race a little bit and is trying to catch up.
Yeah, no, it's amazing. I mean, Intel was a dominant player. I remember back when I started my investing career, Intel was a massively dominated player, but not anymore.
Yeah, exactly.
How about the next one? Strong network effects. How do you think about that?
Yeah, so this is the idea that when you have a network, every additional person or entity that's added to that network raises the value of the network exponentially. So the best example here is a financial exchange. The more people trade on a financial exchange, the more valuable that financial exchange is for everyone that trades on it. It's the old saying in finance, liquidity begets liquidity. So the more people trade in a particular venue, the more they attract other people to trade at that venue, and it raises the value of that venue for everyone. And these are beautiful businesses because they're very strongly protected by many things. But this network effect is really the reason why people coming back to companies like CME or ICE over and over again, because they know that the liquidity that they need to manage their risk programs or their investments is always going to be there. And in fact, it's getting more and more every day. And that's kind of the beauty of these businesses. The other example here is payments, right? Like if you think about the network that Visa exists, I mean, we all take it for granted, but Visa is available in like 135 countries, and there are only 140 countries in the world. So it's everywhere. And the fact that you can walk into a shop and your card just works anywhere in the world is actually a huge thing. If you go back 40 years ago, that didn't happen. And this network that they've built over time, connecting all the different banks, all the different players, is immensely valuable and creates a very, very strong position. Now, again, sort of going back to this idea of this creates breathing room, but it really matters what the company does with that breathing room. If you see what Visa's done, well, it's kept what its take is quite small and has given most of the economics to the different banks involved in this value chain, which creates a strong system because it said to itself, I'm going to build this network, but I'm not going to take the biggest share of it. I'm going to give that away to my partners, which will then maintain my monopolistic power, my moat for me, and which is exactly what's happening with Visa.
Yeah, it's interesting. You know, one of the things that struck me right away when you started talking about this is when people talk about network effects, they almost always go to like something like the social networks. And you've gone a completely different way, which I guess gets at the idea that you're looking at this a little bit differently than other people are.
Exactly. So take social networks. I think the problem with social networks is twofold. And again, we'll definitely touch on the topic of why we think some of these companies maybe don't have the moats that people think. The problem with social networks is the first is time, right? The true commodity that's available is attention and time. That's what's sitting on the other side. So it's your time looking at a particular screen versus kind of everybody else in the world. And because they've reached maximum scale in terms of number of people that they can reach, now it's really about increasing ad load and all those kinds of things. But the truth is, there's a maximum amount that they can reach, and that time is competed for immensely by everything else in the world, all other kinds of media, Netflix, TikTok, etc. And so what we find there is that network is actually a little bit more fragile than people give it credit for, because it's really hard to compete for time. And so, for example, we never really think of media companies. Classically, people put Disney and companies like that in the moat category. Well, actually, if you think about media companies, they're competing for that 24 hours a day. That's pretty hard to compete for. And you can break these network effects quite easily. The example I would give is TikTok, right? Look at its rise out of nowhere. And the dirty secret that people don't really know about is at one point in the United States, TikTok was taking 25% of all Facebook ads on iOS devices. For months, they were doing that. Think about that. 1 in every 4 ads was a TikTok ad. They used someone else's network to build where they are today. And that, to me, is a very interesting dynamic, right? So that means that their networks are vulnerable because they can be used against them. Whereas if you take like a CME or a Visa, no one can ever piggyback off a CME to build a competitor to CME. It wouldn't make sense. And that's these kinds of nuances that people maybe don't think about until they actually spend time looking about it and thinking about, is this a real network effect or not?
Yeah, that's interesting. I never thought about that, but I mean, that actually is an interesting tactic, just buy up all the, ads on a different social network if you have a lot of capital, and that's probably the exact audience you want. I mean, it probably was very successful for them.
Exactly. And the reason is that if you actually define the market properly, the market is attention, people's attention and their time, and everyone's competing for that. And so therefore they can use each other or piggyback off each other to go for it. Now, people like Snap, for example, had a real dilemma in the boardroom. Like, do you let this happen? Because that's like enabling your competitor. But in the end, the money's good, right? So you might take that. And then that's the kind of tension that you get in these businesses as well that don't exist in other businesses.
So this next one is pretty far from technology, which is this idea of non-replicable physical assets. So how do you think about those?
Yeah. So again, we're going back to the roots, almost of what mode investing is about. And the ultimate root is the physical world, right? This idea that physical assets are really hard to replicate. And, the classic example here is railroads. Right now, if you look back in the 1920s, there were like 160 railroad companies in the United States. And today there are 6 railroad companies, large ones. And that has happened over consolidation. But what has also meant is that the rail network that has been built in the United States is a very difficult asset to replace. It has immense value because you're never going to lay that track again. I'm not even talking about environmental, but the country's urbanized, really difficult to replicate that asset. And so the companies operating on that asset or that own that asset are really valuable and have a very, unique moat. And as the world moves more and more towards digital, we're starting to realize it's the physical assets that are the limiting factor and where you're starting to see this kind of moats and dominance come in. And interesting that you say the world of technology. We often try to think of technology as relating it to the physical world where we think the real moats are in technology. So to give you an example, it can be anything. I mean, semiconductors is a perfect example, right? What is the real constraint? Well, it's the physical semiconductors that you need to build, let's say, AI and these infinite computing resources that we're building constantly. That's the real constraint because it's the physical constraint versus the digital unconstrained. Or take a company like Intuit. They do tax preparation software. But the real beauty of it is that it's grounded in kind of a physical world of like what the real tax system is like. And that's people, that's offices, that's kind of paperwork. And what we're seeing is that they have a big kind of service business that underlies it. Most people see Intuit as a software business, but in fact, you need all of that support and service. And that's a physical asset that's difficult to replicate because it's about knowledge, it's understanding of the local, each state has its different tax laws, etc. And so when we're thinking about like software type investment, we're thinking, is there some sort of real world that I can attach it to that gives it more power and more moat?
Yeah, I was thinking about railroads, and this may not be a great example, but I just think about any time anybody in the U.S. has tried to do high-speed rail. It has not gone well. I mean, it's been a very, very difficult thing to do to come up and start some sort of new railroad type project like that.
Yeah, exactly. And it's because you'd be crazy to build new tracks and it's immensely expensive. You think about the environmental, just even the land acquisition costs, the value of land has gone up so much. It's very difficult to build track to where you want it to go, right? Obviously, if you're building it across a cornfield, that's something, but that's not going anywhere that you need to go. It's incredible. I mean, the company on the screen here is one position our fund. They're the first ever in the history of the United States to connect all 4 corners of the US and Mexico together and Canada. So effectively, it's got all ports on each side and it goes all the way down to Mexico. And it's the first time we've had a north to south network under one single operator, which is just very powerful, right? As things progress in the future, connecting a whole continent together.
How about this next one? This could probably be a very strong barrier, this idea of regulation.
Yeah. So regulation is, again, it's a kind of double-edged sword, as we'll probably discuss, but regulation provides effectively what are called natural monopolies. So the government writes a set of rules and it says, okay, these are the rules, and certain companies have almost the license to operate under that regulation. And because that regulation is often immense and keeps getting more and more complicated, creates this barrier to entry for these companies. The other thing to think about in regulation is things like patents as well, which is a form of regulation. It's an idea of, can we give you protection around your business to repay you for the innovation that you've done? So some of the example of companies here are, pharmaceutical companies which have patent protection. But if you take a company like Thermo Fisher, right, people probably don't appreciate how much regulation goes into manufacture biological substances. I mean, it's under FDA review. The plant needs to be super clean. It's literally pages and pages of paperwork that you have to complete. And all of these create a barrier to entry to anyone who wants to enter that business. it's incredible, really. And that's the kind of thing that you see in some of these more sensitive, I think, areas where the governments have had to step in to protect consumers, but equally gives the power to the companies as well.
Yeah, regulation is always interesting to me. And you're kind of seeing it, we're getting back to tech again, but you're seeing it a little bit in the tech space now. Like a lot of these large tech companies are very anti-regulation for a very long time until they get a dominant position. And then they're very pro-regulation because they know their competitors won't be able to catch them. And we'll probably see that in the world of AI as we go forward. We probably will see that. The dominant players will probably change their position, in terms of how they view regulation.
Yeah, exactly. Like you don't need regulation when you're trying to build, but when you're trying to maintain your moat, it's a perfect source of barriers to entry. We've seen that so much with these large technology companies, right? Regulation, it's a term in industrial policy called like regulatory capture. They almost capture the regulation and use it as their advantage. And what we've seen definitely in Europe, which tends to be a bit more heavy-handed on regulation than in the United States, every time a piece of legislation comes out, it just strengthens the position. It's a bit painful to begin with, but it just means that no new entrant can come in and build up the power that these companies have created already.
How about this last one, high switching costs? How do you think about that?
Yeah, again, so very simple idea, right? The idea that switching something out is really, really expensive. And it can be expensive in terms of money, but it can also be expensive in terms of time and in productivity to really switch from one competitor to the other. And the best example here is aircraft parts. The fact is that if you're Boeing or Airbus and you're building an airplane, switching the smallest screw out of a program is, again, reams of paperwork, lots of extra costs, redesigning the whole thing. And that is very, very expensive relative to the cost of that screw and the advantage you might get by getting in maybe a cheaper competitor. And so what you get often with aerospace is these very long product cycles where once you've been designed into a particular aircraft, you're probably never going to get designed out. And there's really no amount of money that it would cost for you to be able to switch to a competitor until you get to the next program. Again, it talks again to my point earlier, which is that position gives you lots of profit, which you can then reinvest to get into a really good R&D position on the next program. And that's the beauty of these businesses. They have this breathing room to be able to keeping their position. Data providers is another great example. Once, you've integrated Bloomberg or S&P into your work process, ripping it out is extremely disruptive. So it creates this beautiful recurring revenue stream for these companies that often only really get changed if there's some sort of change going on in the industry. But that really is very rare.
Yeah, that data provider one hits home for me because, we're quant investors. So everything we do is based on data. And, having done it in the past, when you have to switch your data provider, it's a big deal. I mean, you know everything about your data provider, you know where you need to clean the data, where you don't. You know everything about how it works. And then you switch and it's like quite a shock to the system.
Yeah, exactly. And so the barrier for you to switch, as in meaning the benefits that you have to get, they're going to be immense. And that's why it's difficult for competitors. They're waiting for this entry point, right? Maybe there's a merger or, you guys, you decide to launch a new product and you're thinking about using a different data provider. That's really hard to hunt for and creates this revenue stream for your data provider that keeps them there. Now, you have some companies that milk that and just sit on that and don't invest and build and improve the product until they, the benefits of switching suddenly get worse or, get better because competitors have invested against you. And so the best companies, like, your S&P Globals or whatever, they take that money and they reinvest in building new products so that you're always ahead of the game and really just creates this perpetual monopoly in these places.
This next chart is really interesting to me because you're looking at different competitive advantages and what makes them strong. And on one axis, you have the durability of the returns, and on the other axis, you have how competitive it is. Can you just talk about what we're seeing here?
Yeah, so I guess this goes back to this idea that moat investing is so attractive, and it's a concept that was popularized by Warren Buffett. But actually, you need to really dig deep and figure out which moats are better than others. And so one of the ways we try to present this is in this graphical format, which is start to think about all those different dimensions of moats and to see that they're not all made the same. And so what we've done here is kind of put two axes. One axis is the sort of level of competition that you're seeing relative to each other, all these different industries. And the other one is really about the durability of the returns. This concept that I said, we always start with that. We always think, how durable is this business and its returns versus companies where the durability of returns is less. And then we try to plot industries across this. And so what you can see is that what we are trying to do is we're trying to look for companies where there's less competition, or industries, there's less competition, i.e. that there is kind of big competitive advantages, but also where the returns are a lot more durable. Companies that we discussed before, like data providers and railroads, that's where they live. If you think about what you maybe don't want to invest in, but it's still in many places considered to be a moat, it's places like e-commerce or social media, where the returns are probably not as durable as people think, and the areas are a lot more competitive. Often these get supplanted by this idea of brands, which is what's supposed to carry you through this, right? Take for example, media. Media is all about brands, but the truth is brands can also be broken, and they seem less competitive, but they're actually a lot more competitive than people give them credit for. And so what we're trying to do here is show this graphical presentation that even though you might think some of the companies in pink here are moat companies, actually, once you start looking under the surface, it can become a lot more difficult, and there are better businesses to invest in if you think about other dimensions.
Yeah, one of the things that struck me right away with this chart is this idea we talked about before with technology, that almost everything related to technology is pink here. You really are looking, it really sort of spells out what you've been saying all along in terms of these technology moats may not be as strong as many people think.
Yeah, exactly. And I think if you look at the history of technology, it's about disruption. But I think what's happened maybe since the advent of the internet and PCs is that the disruption happens in much longer cycles, and it's a complete paradigm shift of how computing gets done. So if you think about how we went from the PC era to the mobile era, and how the players that have won in the mobile era, Android, Apple, are completely different to the ones that were winning in the PC era. If you go back to the 90s, people would have looked at Dell and Microsoft and Intel and said, that's going to be forever. These are strong companies. They have the best distribution, the best technology, the best people. And lo and behold, once the mobile era came in, Microsoft was nowhere in the mobile era to begin with. Intel was nowhere in terms of mobile chips. It was supplanted by ARM, and the Dell was nowhere there. It was Apple and manufacturers that were using the Android ecosystem to build mobile phones. Now we're probably entering another era of that kind of paradigm shift, which is AI. This idea that where are we going here in terms of, could this completely change the kind of devices that we're going to start to use? So if you went to CES this year, you would have seen lots of interesting devices where it's just an AI assistant on a little box. Could that be the thing that disrupts Apple? Who knows? But that's what the history of the technology business is about. It's this sort of it's almost like the rug gets pulled under them, and suddenly they have to figure out how to live in a completely different world. Whereas if you're a financial exchange or medical technology company, that doesn't change. That doesn't happen as much. These paradigm shifts don't happen. And that's why we always sort of think technology is way more competitive than anyone gives it credit to. That's not to say there aren't areas that are less competitive than others, but that's kind of our general position.
In researching your strategy before we talked, I noticed you mentioned this idea of cash flow ROI a lot. Why is that important to you, cash flow ROI?
So look, we talk about monopolistic businesses or strong moat businesses. And when we talk about that, like, what is the benefit of this business financially, right? It's all well and good to talk about the qualitative side of moats and analysis of moats. But once you've determined the companies that have tangible, durable, dominant moats, what am I going to get as an investor? Well, really what you're going to get is this high cash flow return on investment. We focus on cash flow because that's the ultimate metric. It's difficult to manipulate. It's very easy to understand. It's the cash that comes into the business every year relative to the investment that's been put into that business. And it's this idea, the quote says here, is it's about consistent value creation over time. So if I find a business that has a wide moat, like the ones, put here, they tend to have a high return on invested capital. But to make those a good investment, and this is where our approach is slightly different, you need that to sustain for a long period of time. This is why I spend most of my time thinking about the durability, the tangibility of that particular advantage. And the reason you need it to sustain for a long period of time is, and I'm sure we'll get onto this topic, is that often the market's not stupid. It can see the high returns on invested capital in these companies. And the only way share prices go up is if they consistently beat expectations. So the idea is that how do you invest in this company that has high return on invested capital and get it to beat expectations over a long period of time, well, you invest in one that is very durable. That's the idea. And really, it's as simple as that. I buy the subset of the wide moat portfolio companies that have higher cash flow returns on invested capital, that have tangible, durable, dominant moats. And then I sit back and kind of hopefully enjoy the returns from these companies if I've done my analysis right. And here, what we've presented in this chart is kind of, okay, so if you're earning 17% on these wide moat companies for a long period of time, well, that beats pretty much all of the returns from even the average of S&P companies. So here's the cash flow return of the average of those companies or MSCI World. And just for fun, I stuck in US Treasuries as well. So this is the kind of compounding you're getting inside the business, which is what will drive the share price over time consistently. And that's kind of the idea here with using cash flow return on invested capital.
How do you think about this idea of people challenging moats? I mean, I assume with certain types of businesses like railroads, it probably doesn't happen too often. I mean, it's very hard for anybody to even attempt to challenge a railroad. But when you see a threat to one of your companies, like, how do you think about analyzing that in this context to think about it? Is this a real threat? Is this business something that's at risk?
Yeah, so it's a great question, right? Like the point is that once you've established a moat, you've bought this good company, you really need to keep watching it, right? Very, very carefully. And the way we sort of think about the challenges is we kind of think of like almost like a grid, right? Which is you've got your competitors and you've got the company itself. And it's about offense and defense. Each of them is playing offense and defense in their particular way. So, and then how I analyze offense and defense is I try to use kind of military kind of analysis, right? Which is all about force size, like how big is that thrust coming in, right? How much money effectively is being invested in it? And then I think about what kind of strategies are they using to get to defend or to attack? And then similarly, what kind of tactics are they using? Again, also very important in terms of the day-to-day monitoring of these companies. And so if you take technology as a great example, now I'll probably get these numbers wrong, but we're talking about like 1.5, maybe $2 trillion invested in venture capital since 2010. So when I think about force size of like that attack on technology in terms of venture investment, and all of it is going into technology. It's not really going there chasing, railroads, right? That's what they're going after. And that's force size is pretty strong thrust of attack. And then I think, okay, what kind of strategies are companies employing against these technology businesses in terms of deploying that capital and getting after it? And I'm moving away kind of value destructive business model, but there's loads of interesting strategies that people have done to disrupt various businesses. Similarly, I think about the company I'm looking at and saying, okay, what's this company doing? It's very important that this company has the right defense against all of this, like any disruption that's coming its way. But equally, and I think also underestimated by the market is what's the offense that the company is playing, right? Like what is it doing to maybe get ahead of everybody? Like where is it attacking in terms of where is it deploying its capital and spending money? And so when I sit down with every company, I'm kind of thinking, okay, what are the competitors doing in terms of their offense, in terms of strategy, tactics, how much money is coming into that? And what's my company doing in terms of offense and defense? There's also another element of the quadrant, which is the defense of your competitors, which can be interesting against the offense of your company, if that makes sense. So there's this like interesting balance. And then it's a lot of qualitative analysis where you have to make a decision at the end, whether it's prone to disrupt or there's a kind of disruption going to happen or not. And it's really the big risk for a lot of these companies. We have to be careful. But if I've done my work right on the moats, should be in really good shape for the core business itself. This is more about how the story progresses over time, because I need to be watching that very carefully.
It's interesting. When you were mentioning 0% rates, I was thinking about, I mean, that might be changing in the future. A lot of companies were threatened, their competitive advantages were threatened by 0% rates and a lot of money being thrown at stuff. Now that rates are higher, you could argue those threats are going to be much harder, to bring forth than they were in the past.
Yeah. So it's like this cost of capital point, which I think is very interesting. But my counter to that a little bit is this venture money was raised, right? And some of it was destroyed in terms of bad investments, but some of it is still sticking around and they've raised quite a lot. And what's also happened, and this is this progression of wealth over time, right? The society is getting wealthy. There's more and more investments around, which are trying to find more and more return. And because venture as a sort of risk-seeking place has kind of established itself very well, I would say, over the last 10 years as allocation of investors, I don't think necessarily you're going to see money move away from venture And because they play this trick, right, they don't need to give you a return because they say, hey, your money's locked up for 10 years. You call us in 10 years. That means that it's not going anywhere, right? So it's kind of, I think in the traditional world, maybe 10, 20 years ago, the cost of capital mattered because the people who are directing it had to report against that cost of capital. But we're in a slightly different allocation paradigm, I would say, which makes it a bit difficult for companies. It'll continue. That's what I think. This amount of capital. Now, are they all going to be throwing, just $100 off vouchers at you? And is that era done? Probably not. Yes. But some of those strategies work, so they might continue in different ways.
So this may apply less to your companies because, again, you're investing less in technology. But one of the things you're seeing a lot now is a lot more stuff going on the regulatory and antitrust side. And again, particularly with the technology companies. But how do you think about that? If that's a potential risk for one of your investments, how do you think about monitoring that and judging the size of the risk?
Look, it's the question, right? Because I think hopefully I've identified really strong moats. The biggest risk to those moats is more like a regulation in the form of antitrust and basically the DOJ or the FTC going after these companies, or also other types of regulations. Railroads in the US are regulated very carefully. There's labor unions. There's all kinds of other bits of regulation that go after it. But antitrust is the most important one. And so what we've done is we monitor it extremely carefully. I've built a dashboard that monitors the news flow out of the European Commission, the Department of Justice, and the Federal Trade Commission to basically try to stay ahead of what's going on. Like, what are the people there talking about and thinking about? What was their academic work like? And I think that's something that we're trying to differentiate on. We're trying to defend against those risks so I can try to spot them a bit earlier maybe than the rest of the market. Because the market is a bit lazy when it comes to antitrust, apart from merger control, where there's an entire industry doing merger arbitrage. But I'm going to share a slide, which I think is very interesting in terms of just the general background of antitrust, right? And again, I think this is like fascinating data. This is the number of DOJ investigations by type, and this is the number of European Union antitrust cases. They've gone down massively. And this is the thing that I think the market, people aren't really aware of. And one of the reasons why we find it been such an attractive strategy to invest in, because there's just antitrust authorities are doing less and less. And I think this is a nice background as a sort of tailwind for the strategy as well, and the way of looking for companies that are dominant in their particular positions. Just less antitrust.
It's interesting to think about that in the context of like the news flow, because I think the reason a lot of us, me included, would think this is not true is because if it's Apple that's under investigation, people are talking about that all the time, or if it's some other big company. So you probably hear a lot of news about this in terms of, the big tech companies, but the reality behind the scenes is very different. So that's very interesting.
Yeah, it's like the classic thing, right? Like we're often having to fight against like the media narrative as investors, right? To be like, look, if you actually look at the data, it's completely different. But the media will write about what it is. And those are banner cases, right? I think they're very interesting cases. And we'll talk about technology in a bit, I'm sure, and these companies specifically. But like these companies, the cases are not that great, right? They just create a lot of news and press. But I actually, I've spent a lot of time reading the actual case documents, and we'll see how the court cases progress. But it's difficult to see what kind of case you can make for these technology companies being really that dominant. But yeah, this is what's going on under the surface. The DOJ might be doing more big cases like Apple, but overall less and less cases over time.
How do you think about blending quantitative and qualitative in your process? As the quant investor, I always have to ask this question. But like, how much of finding a moat can be quantified? I mean, I think at the surface, you could look for high return on capital sustained over time, or something like that. But how much of this is qualitative and how much of it is quantitative?
Well, I think it's we can probably do an entire podcast on just this question. And as a quant investor, you probably have lots of views. I generally think we want to harness the best of both things. And I think I kind of really subscribe to the kind of Gary Kasparov view that like man plus machine is probably going to be the best investor there is out there, or the best at any particular task. So we employ quite a lot of what I would call like systematic tools to help us, guide us in various areas. And what we did when we set up Tema was we sort of thought, okay, what areas of the investment process do you think systematic approaches work best, and what areas do you think should be left to kind of human devices? And what we generally settled on is portfolio construction, as in like how you build a portfolio, should probably have some systematic elements related to it. Fund managers, again, as a fund manager, it's hard for me to say, we were not very good at sizing positions or putting together the final portfolio and what it's supposed to look like. But we're very good, better than 100% of the alpha generated over the best fund managers at picking stocks. That's what we do, right? And so I think what we wanted to do is say, okay, can we create a fundamental process around picking stocks, using the qualitative side of things as much as possible, employing all the classic quantitative tools in terms of spreadsheets and models and analysis, getting into the weeds of the companies, but leave that to the kind of human side. But when we think about portfolio construction, for example, can we put in a set of rules and some systems that help limit the choice a particular fund manager has to harness the best part of that stock picking alpha? When it comes to idea generation, I think that has to be free, right? Because in a way, ideas can come anywhere. They can come in the shower, in the newspaper, whatever you're reading, and you don't want to have too many rules around how that a particular bit works. Within our fundamental analysis, we use a lot of quantitative tools, but they're for specific bits of analysis within that particular bit. When I'm looking at balance sheets, we have specific scores that we've built based off models, based off academic literature that tell us the risk of accounting the statement, the risk of balance sheet problems. Often you need to be able to monitor these things from lots of different angles. Otherwise you kind of miss things. And, one thing that I'm big on in Tema is the sure way to lose money as an equity investor is to get the balance sheet wrong of a particular company. Time and time again, that's always how you do it. And you lose money and you never get it back. Yeah. The company has bad earnings. The likelihood that it'll bounce back is pretty high. The company has a bad balance sheet. It's over, right? Like often for equity. So we build a few quantitative tools for specific bits analysis. We try to use quantitative tools for our portfolio construction process, and we leave the rest slightly open. But it's an interesting idea that you point to in terms of the moat and the deep moat analysis that we do. Really, it comes down to this point that actually it's very qualitative, right? Even if you take the dominance point, right? Just a simple fact, like there is no database that exists that can tell you the market share of different companies. It just doesn't exist. There is no single source like a Bloomberg where I can go and look up any industry and it'll tell me the market share. And therefore, there's no way to screen for dominance in the industries, which is kind of crazy to think about, right? Like we spend all this time thinking about market share, but the data's not there. And then when you look at the actual moat analysis, especially the way we do it, it's very qualitative and very intensive. You have to do a lot of reading and understanding.
To your point about blending the two, I mean, I think that's one of the things people miss is everybody pretty much blends the two. Even people like us who are pure quants, I mean, somebody has to decide what's in the model. Somebody has to decide when to change the model. So this idea that you can completely eliminate discretion isn't true either. Every process I think has, it's just a matter of varying degrees, but every process blends those two things together.
Yeah, and I think that's the way it is, right? I think the world loves black and white, but the truth is it's always gray, right? There's always a spectrum of things that people are doing. Similarly with our approach, where our ETFs are actively managed, but that we have rules on our portfolio construction. Does that make us more of a passive vehicle? It doesn't really, right? But it's like a continuum, and even passive instruments, we rail against them all the time, but they're making decisions, right? Index inclusion, exclusion criteria, all of these things are someone's made a decision somewhere that will affect the outcome for the investor.
I just wanted to ask you briefly about inflation, because in theory, I would think these types of companies might be companies that might do well in periods of inflation. I mean, they typically have pricing power. They're hard to replace. I mean, do you think that's true?
Yeah. So absolutely. I think what's quite clear, and here what I've done is looked at quality stocks, which you think of quality stocks as kind of the bigger subset, right? Moats are a subset of quality stocks. There are quality stocks that don't have moats necessarily. But what we've done here is look at quality in terms of different periods of inflation and how it does. And then what's even more interesting is that if you put a value overlay, as in like you look for cheaper quality stocks, they're the ones that actually do the best on average in inflationary periods. And why do these moat quality type stocks do well? Was what you said, really. It's a lot of their revenues are highly visible in some infrastructure businesses where in their contracts, there's like a direct indexation to inflation. Or even if you take some of the aircraft manufacturers, right, they have price escalators built on inflation or regulation or indexing. A lot of the times what moat type businesses are is they sort of collect a little bit of a toll on like a growing pool. And that growing pool is a nominal pool. So for example, a classic moat business from our perspective is ratings agencies. Ratings agencies essentially rate debt, but they collect the fee of the nominal stock of debt. And just by inflation, that nominal stock of debt is inflating, right? And so you have more and more nominal inflation, and you're collecting a fixed percentage off of that, or even a growing percentage. That creates the kind of benefit for these companies, which then flows through to the bottom line. So quality value stocks tend to outperform historically in inflationary periods, and moat stocks are definitely a part of that. And this is the reason why we think that happens.
How do you think about valuation? I would think this is one of the more challenging things, because we know these are all great businesses, but they'll say, any business at a certain price is no longer attractive. So how do you think about figuring out like what you're getting for your money and what an attractive valuation is for these companies?
Yeah, that's a great question. This is a hard part. So in general at Tema, what we do is when we look at any particular stock, we look at 4 pillars. And one of these 4 pillars is building a valuation case for the business. And it's a very, very important pillar because, as you say, a great company is not necessarily a great investment. That's a classic line in investing, and it's really, really important to understand. And so it's a bigger challenge for these types of businesses because they tend to trade either at or above the market multiple. And so therefore you're paying up for the quality and the protection of that business and the visibility of those earnings. And so what we try to do always is look at 2 things. One is we always look at valuation relative to the fundamentals of the business. So I'm talking about the return profile of the business. I'm talking about the organic growth rate it produces and the growth rate of earnings. That's very, very important to do because what you want to do is ground it in a way. And no, I'm not suggesting looking at PEG ratios or anything like that, but you need to make a holistic assessment of the fundamentals and try to link that somehow to the valuation multiple. Often what it also means is an analysis of the company versus its own history, because these companies have long durability. You can kind of see where it's traded versus its own past and what kind of multiples it's gotten to. But I never really build an investment case based around valuation as a driver. I'm always looking for the fundamentals to do all the work. It's going back to that cash flow return on invested capital. That's the thing that does the work and the ability for that business to reinvest and compound and grow. And so what I'm trying to do is say, okay, is it fair value or is it a good valuation case relative to the fundamentals of that business? And you can easily build these cases, right? Because a business which has a very long, say, runway because it has a fantastic mode of its business, it can keep growing. If it's growing revenues in high single digits, expanding margins because you have operating leverage in all of these businesses, you're starting to see double-digit kind of earnings growth. And if you add the fact that often many of them throw off cash, which they can reinvest in the business, you're quickly getting into this double-digit return just from every year in, year out growth in earnings, which is coming from that cash flow return. And that does a lot of work for you as an investor, right? In the marketplace. If I can find companies that are doing sort of 15% IRRs, put in the dividend yield of buyback yield plus the earnings growth of the business, well, that definitely beats the S&P over long periods of time. And if I can then do all my work to make sure that there's durability to that, I don't need to make any heroic assumptions about the valuation multiple. Where valuation is extremely important is the downside case, right? Because of the picture I painted you, any niggle, any problem that can spiral into a bad story about the company will see a massive valuation discount because there's so much valuation to give up. And so that's why I'm spending so much time, for example, building dashboards, looking at antitrust analysis, because I'm like, if that torpedo comes, there's a long way for this thing to fall because people might value it at a completely different multiple. So we do as every quarter, we assess all of the risks, disruption risks, which we talked about before in terms of offense, defense of the companies, antitrust risk, and any other risk facing the company. I don't really care about cyclical risk that much because over long periods of time, these companies through cycle are going to be fine. But what I care about is there anything that the market can build into a structural story? And that can be very painful for these companies. And so that's where I think valuation analysis comes in very carefully.
I want to ask you about portfolio construction, because that's always one of the interesting things is taking all these great companies and how do you put them together into a portfolio? How many positions do you hold? How do you size the positions? How do you think about sector concentration? Can you talk about that? How you think about translating these great companies into a portfolio?
So as I mentioned earlier, we had a long think before we started Tema about how to do portfolio construction. It basically involves quite a lot of research by myself and some of my colleagues in terms of like going and reading academic papers, talking to a lot of other fund managers and what they do in practice. And the reason is I wanted to really answer this question, right? Like, how do you size an equity bet and a position? And how do you build portfolios that are the most efficient? And what I alluded to earlier is that fund managers aren't very good at this. We're just overall, we generally actually tend to lose alpha when we're trying to size positions. And there's a lot of reasons for this, mainly related to behavioral biases. And so what we came up with is this approach of trying to build different tiers of position size within the portfolios. And these tiers of position size are built around conviction, but they're also built a little bit around size, which is what the risk managed approach is. Size is actually one of the best variables. And people kind of hate hearing that because they always think, well, you're an active manager, you should not really care about how big a company is, and isn't really the value added from small, medium-sized companies better than larger companies. But size is one of the best variables to determine risk parameters of a particular business or investment. And so what we do is we have these 3 different conviction tiers. And what fund manager, essentially when you're managing the money, you're trying to move between the different tiers based on your conviction. But within each tier, it's equally weighted, the position sizes. Of course, over time, they drift, and you want to make sure that you adjust those over time. But what this does is it creates a conviction portfolio that's kind of risk managed in a way. It restricts the amount of choice you can make as a fund manager, and it really focuses you down on that conviction. So you're making only really 3 choices here. And really that the stock pick itself is the valuable thing, not the position size. So, here we've got this foundation position. That's a good way to think about it, right? Which is, often fund managers have a long tail of smaller positions that they're sort of just watching. They bought a little bit. They thought it was a good idea. This is actually kind of really detrimental to investors because 1, that's never going to have a real impact on the performance of the fund because the position is often too small. 2, a lot of ideas, despite fund managers kind of telling you, often good ideas, at least moving between ideas, they have a set life, right? The alpha in ideas tends to be very high at the beginning, but it actually decays over time. And so what you want to make sure to do is that you size the position right to begin with so that the investors actually benefit from that good idea. Whereas what tends to happen is people may size the position too small to begin with, ramp it up at the wrong time when the alpha's already gone from that particular idea. The other thing about having tiers is it forces like some biases out of the process. Like, for example, this bias I just said, which is this idea that, just because I have a small position, I'm good. That's a biased view, right? You shouldn't have a small position in that particular thing. But also it limits kind of trading, right? Because you have to make a big decision each time. If you have to trade 100, 200 basis points of that particular position, you think twice, right? You sort of, and you do less trading when you're trying to tweak things where it just creates costs for investors. And so this is the result of the work that we did in terms of understanding what the industry does. I'll comment on the industry is that we're not very good at it. There's not a lot of really good models for how to do this, and people try lots of different things. But it was a difficult kind of balance to try to find what is the easiest way to do this that is most correct from an academic perspective, but is also inherently understands that there's a human involved in this process as well.
To your point on size, I would assume that most companies, and correct me if I'm wrong, that meet your criteria would probably be on the larger size, because if you're going to have this kind of protection against your business, you're probably not going to stay a small company for too long. I mean, you're probably going to be bigger.
Yeah. For the fund, focus on deep moats, it's really that they're a larger company, but there's relative to size to each other. So for me, for that particular portfolio, it's much more conviction based than it is really related to size. But if you take some of our life science funds as an example, where you have a real stark difference between the smaller companies, which tend to be pre-revenue biotechnology businesses, and the larger, more established businesses, there, the range is a lot more stark, and that's where size plays different. Remember, this is an investment process in terms of portfolio construction that applies across all of Tema funds, and it's supposed to fit kind of the different areas all the funds invest in. But within deep moat business, absolutely, it's really just conviction rather than size that matters, because size is quite high anyway for these companies.
Just a couple more before we wrap up. I wanted to ask you about international exposure, because this is something you do that a lot of these types of funds typically don't, which is you do have significant exposure in the international space. And you do, most of us that are, in the US will think, oh, all the great businesses are in the US, but that's not true. I mean, there's some great businesses abroad as well. So can you just talk about how you think about this in the international world?
Yeah. So right now the fund is about 75% US. So it's very much kind of a US focused fund. And I think speaking to your point, I think really good, high quality, deep moat businesses, they tend to be in the United States. I think that is true. It's kind of the most powerful, biggest market in the world. And I think that's the reason why it's bred a lot of these best in class businesses. But that's not to say that there are no really good businesses internationally. And so 25% of the portfolio is positioned overseas. About 6-7% of that is Canadian rail companies. So as I said earlier, I picked on one of the companies. I just generally think they're slightly higher quality than the US listed rail companies. By the way, they're listed in the US. A huge part of their business in the US, as I said, they connect all the different parts of the United States, but they're still classified as international. But if we start to look further afield, I think one particular area that is really underrepresented in the US market that I think is very powerful in terms of deep moats is infrastructure businesses. I'm talking about airports, toll roads, businesses that own and operate, like build, own and operate infrastructure is a very bizarrely not a big part of the US listed market. You tend to have a lot of like construction businesses that create infrastructure, but not a lot of them that own that infrastructure. And so we found the best ones tend to be listed in Europe. They're fantastic operators and builders of like airports. And these are incredible businesses because really a toll road, if you think about it, once you build that toll road, it's a toll that is linked to inflation, that has a concession of sometimes 50, 60, 70 years that compounds over a long period of time. And they create immense value. I mean, one of our companies owns a toll road in Canada. I think originally their investment was like, they 40x'd their investment just through operational performance, but also just compounding over time. They own managed lanes in the US, which is a really interesting kind of asset of like dealing with congestion around cities. So creating specific parts of a highway where you pay a toll just to avoid congestion. And that's continually part of, unfortunately, the reality in urban centers. And people are prepared to pay for it, right? And that's the kind of assets. Or airports are beautiful businesses as well, long concession. They are regulated on certain parts of it, but lots of it is unregulated, like the concessions you have in the shops, right? It's a captive audience, travel is growing, they're investing in these businesses, but over time they're able to reap these rewards. And so we found a lot of really interesting businesses listed in Europe that operate infrastructure, including infrastructure in North America as well. They're just not listed in the US. And then you have some of the real international gems, companies like ASML, which is a perfect example of a business that is just 100% monopoly business with the deepest possible moat. I mean, just so people can get a sense of what that business is, they provide the lithography machines that you need to have that source of light to be able to cut those semiconductors I was talking about to 2 nanometers. These machines are like 6 stories high. They cost $300 million. They require like 50,000 different suppliers to come together to build it. They have a mirror inside them that is so perfect that if you blew up this mirror to the size of the Earth, there wouldn't be a dent more than a centimeter in it. And this is the kind of like advantage this company has. It's the only one in the world that's able to build these machines. And you just don't have that in the US. There are amazing semiconductor equipment businesses that we own as well, but this is a business that is just quite unique and doesn't exist. Or other ones like Novo Nordisk, that's a great business that's developed the obesity drug, Wegovy, and it's just a fantastic company in that sense. So it's just finding those really strong competitive businesses internationally. That's what we're trying to do.
Yeah, I listened to like a long podcast about ASML one time, and like what they're doing is it's going to be very hard for anybody to compete with that for a very long time. It seems like.
Yeah, I mean, it's still technology, right? Someone might be able to find a new way to do it, but I think it's very difficult to do that. And again, it goes down to this: it's technology, but it's in the physical world, right? I'm trying to work a physical thing instead of the digital world where the pixels are free flowing. If that makes sense.
As we close out all our interviews, we like to ask all our guests a standard closing question, which is based on your experience in markets. If you could teach one lesson to the average investor, what would that be?
Yeah, great question. there's a lot of things that I thought about answering this question with, because there's always a lot of stuff. But I think in my mind always drifted back to kind of the simplest things, because what I always find is that the simplest things, they seem simple, but they're actually really difficult to do in practice. And the best lesson that I learned maybe over the last more than a decade of investing is kind of this just using common sense as a real simple tool. Often what I see with investing is people get attracted to things, they fear of missing out, all of these emotions that come in. And what I always sort of say is, if you just apply common sense, like if something's too good to be true, it probably is. Just because someone else is making a ton of money over here on something and you don't really understand it, don't rush into that just because it's going up. And so I often kind of give this lesson to a lot of people that ask me, like, what's the number one lesson? It's like, look, if you don't understand it and you can't apply common sense to this thing, probably not a good investment over the long run. And we've seen that time and time again with the different cycles that happen. I always implore people, just try to use common sense, try to understand what you're investing in, and you'll actually come very, very far, farther than what the market can do as that specific tool.
So this has been great. I really appreciate all your time. If investors want to find out more about you or about Tema, where can they go?
Yeah, absolutely. So you can head to our website, which is temaetfs.com. There you can see all the different funds that we manage, including the one we discussed today. And there's lots of information under our insights page. You can subscribe to our newsletter as well, where we try to publish interesting bits of research about the various parts, including our investment process. So yeah, that's probably the best place to go.
Well, thank you again. I really appreciate your time.
Sure, my pleasure.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.